Good afternoon. So this is a trade review. It's currently Saturday, 28th of Feb, 11 p.m. And this is a trade review on Tuesday's trading this week, 24th of Feb. So what is sitting in front of you is me taking a very what can I say, I think one of the best trades I've taken in a while. I literally almost shorted the high, and I took it from pre-market session, and I held this trade till regular trading hour. So those schematics of this trade is we had premium prices, and we had like this premium wick on a 15-minute time frame. So you're not going to see it clearly because this is a 1-minute chart. This is displayed on a 1-minute chart. So the premium wicks quadrants have just been transposed to a 1-minute chart, and so you can see the premium lower quadrant, the consequent encroachment, and its upper quadrant. So now price had recently traded to its consequent encroachment, but if you look carefully, what had just happened is we had pierced consequent encroachment, and the bodies had came back and closed below it. So what does that indicate? Well, that tells you that there's weakness in this market. Okay, not weakness, but there is some sort of weakness coming into the market. It's irreluctant to go and gravitate up higher. It shows an unwillingness to soar higher prices. So that is a sign of early. Those are the signatures of early reversals coming in the marketplace. And so that was the whole context of the trade, and so that's why I shorted at the high. And so that's how I got my position in. It wasn't based on any other PDA rates besides that quadrant and how price had reacted off it and its premium sensitivity. And so I decided, let me show 5 contracts on this, and you would see the inversion fair value gap that it had inversed off and rejected off to soar lower prices and fall out of bed. So excuse me, this was me just logged out a little bit. So the fair value gap that you see, that's shaded in I don't know, you could say red, I guess velvet red. Yeah, that was the pre-market session first presented fair value gap. So at 7 o'clock, after 7 o'clock, that was the very first displacement we had put in place, and so which made it the first presented fair value gap. And so our price was currently trading inside of it, gave us an order block, rejected off that order block, couldn't even get up into it and close inside of it. We only saw wicks inside of it, creating another propulsion block. So the thing with propulsion blocks is, the way we use propulsion block is to weather price as a form of immediate rebalance. Okay, excuse me, I'm stumbling over my words. A propulsion block is basically a order block that had traded previously into another order block. So that propulsion block acts as a immediate feedback on whether you're on the right side of the market. So when price trades into that propulsion block, we would expect some level of sensitivity inside of it. So in this case, we had a bearish fair value gap. So when price traded into it, you would expect some level of rejection and sensitivity off it. So you don't want to even see it trade up into the consequent encroachment of that gap. Of that fair value the propulsion block, excuse me. You would expect some level of rejection of it. And so that's why after it had rejected off if it's open, that's when I noted that I would like to see some heaviness in this market, because it tends to get a little heavy when it had just rejected off an order block. And so that's exactly what just happened right now. We've seen displacement lower, And yeah, that was also me annotating that I want to see large black limousines down there, which means I want to see bearish candles. And then I just took out sell side liquidity minus sell side liquidity. So the job's not done yet. And so reasonably I would take off contracts, but since I'm targeting a key level that's way below that price level, I cannot take any partials just yet. It's very early in the trade. What I can do is trail my stop loss. So that's exactly what I did. I traded into profit. That's what I like to see. That heaviness. That's what I'm saying. So this trade was a pre-market session trade. So it was a trade ahead of 9:30. So that when 9:30 opens up, when the market opens up for regular trading session, there will be some sort of liquidity injected in the marketplace, and that liquidity will be in the form of a sell side delivery. So that was the whole, idea of this trade, is to get in before the pre-market session and before it could, plummet lower as a fake suspect rally to take out sell side liquidity, take out sell stops, basically resting in that marketplace, and then eventually delivering its original, trend, giving its hand to us. So as price, I had just created a SIBI and it had just rejected off it. Notice how I couldn't even close inside of it. We only saw wicks get inside of it, and it pierced the high. That's weakness. That's price telling you that it's very weak. So what I'm doing now is I'm getting the consequent encroachment of that premium wick to get the consequent encroachment of that wick. So the whole point of that is to determine whether the price is still weak and I'm still in the favor of the market. As long as price trades below that consequent encroachment and does not close above it, I'm still in the right direction. It's basically immediate feedback, just telling me that I'm in the right market. So those are smooth relative equal lows resting in the marketplace, and so that's what I'm creating there, minus sell side liquidity. It's minor because it's not our primary objective. It's one of the hurdles we have to go through in order to reach the terminus point, which is all the way down there. Asian sell side liquidity, the Asian lows, formed during the time period of midnight Eastern time till 5 o'clock. So that's how we were able to determine those lows. And boom, they take them out. Now watch how it takes them out. Watch how price close below them. You see that? You see that speed? That's weakness. That's price reluctantly weak, basically. So now I've trailed my stop to that above that consequent encroachment. So that's what I've done. Now I'm trailing it to the low, the previous low we had, because it's unlikely that it will get up there. If it's exceedingly weak, there's no need for it to get back to my stop loss, to the high, the previous high that I set my stop loss at. So that's that speed being injected in the marketplace, just right ahead of the opening range, the 930. And then boom, it took out another minus sell liquidity. Now it's the opening, but now you can see the liquidity being injected in the marketplace. Watch how it gets very close to my stop loss on that liquidity that's being injected, but it doesn't even trigger my stop loss. It gets really close to it, but it doesn't get it close enough to take me out. It goes to show that this comes with experience. This comes with practice, tape reading, days and hours of tape reading. So for you to be able to pull off these type of trades, selling the highs, and getting off the lows, it requires a lot of experience, folks. And so right there, that was the Asian session lows, and I should have taken out my profits right then, but I had become too greedy and I trailed, basically moved my TP, something that you should probably never do as a trader, to move your target profit. You should know what you're looking for before you even take the trade. And so in this case, when I was taking this trade, when I executed this trade, I did not know. I hadn't planned it out yet, where I was going to enter, where I was going to set my TP, where I was going to take my targets. And so the result of that is me getting stopped out, where I could have banked more. I basically left money on the table. I had become too overzealous, let's say. So now I'm moving my TP again, exceedingly low. So I think that was really a bad trade management. I shouldn't have done that. That's something I actually learned from that day. So now what I've done is I've trailed my stop loss to the open of the regular trading at 9:30 open. So the reason why I didn't trail it to, I guess, the previous low is because I'm allowing it, in case if it wants to gravitate lower and really get animated on lower prices, I'm allowing it, to, oh, excuse me, something has just happened here. So the reason why I'm setting my stop loss all the way up there is because I'm allowing it to, if it wants to get animated low, it could retrace on me. Maybe I might experience some little bit of pullback, and that pullback will just get high enough into the first percent fair value gap where my stop loss will be above that, and then if it's still exceedingly weak, it will reject off that first percent fair value gap and soar lower prices. So that's why I'm setting my stop loss way above that first percent fair value gap, just in case that scenario pans out. And so that was the whole trade that I took. That was it. And so guys, excuse me if my speech is a little bit slurred. It's late night and I'm really tired now, and if you cannot hear me, probably I'm very tired, so excuse me for that. And yeah, thank you for your patience. Thank you for being here, sitting here with me today, and going through the trade review, because I think it's very helpful. And yeah, thank you.